Hello, my name is Matthew Kidman and thanks for joining me today. I'm the co-founder and principal of Centennial Asset Management, and the fund we're going to talk about today is our Level 18 fund. The Level 18 fund is managed by myself and my partner Gary Joffe, and between us we have 35 years experience in the funds management industry between Wilson Asset Management, Ellerston and Citigroup. The Level 18 fund is a very interesting alternative for most people out there. It concentrates on small companies, but it has a lot of flexibility. And the reason that is because it grew out of our own investments. We were managing our own money and we decided to do a fund. And so the principles of investing the Level 18 fund is if all the money was our own. And so it has some unique features. It can be 100% long, it can be 100% cash, it can even short stocks. It typically is about 70% invested, but we like all on the long side, but we like all the bells and whistles because the primary idea is we don't want to lose you money and we don't want to lose our money. At times we will, but we want to limit that damage. We don't want to turn up one day and say, hey, we're down 25%. They're hard to recover. We like to have all the flexibility we can to generate a return. As I said, we're pretty committed. The founders have about 20% of the fund and we want to keep it at a certain size so it can perform and execute on its objective. So we want to grow it to about 150 million, which is the idea behind a small cap fund because it's flexible, it's small enough to perform and to perform over time. Our number one goal is to preserve capital, and I think we've done that over time. And we want to outperform not only equities, because we're benchmark unaware, but we want to outperform cash and give our investors a decent return that they can rely on. How do we go about that? As I said, we like to be long the market, typically about 70%, sometimes it'll be more, sometimes it'll be less, but we operate primarily in the small cap market. And why is it? Because that's risky, and how much risk do you want to take? You try and limit your risk by getting returns. But the small cap market is good because it delivers companies that can grow by nature. Small companies coming off a lower base in the right niche are going to be growing faster than bigger companies. They might have more risk, but they deliver better returns over time, we believe. What are we looking for when we're looking at a small cap company? Well, we're looking for that growth. We're looking for it at the right price. We're looking for it to be able to fund that growth because I don't want to give money to a company to build their business. I want them to have a business that I can invest in and get a return and to fund that. If they want to make acquisitions, and it's a good acquisition, we're happy to fund that, but we don't want to be the funders to build a business. We want to be on a business that's funding itself. And of course, like everybody else, we want good management teams. Management teams are very important, hard to measure. It's normally in hindsight. You can see how a management's performed, but what do we look for in a management team? Well, we like management teams that are honest, direct, and they take into account all their stakeholders, just not their shareholders, their customers, their suppliers, their boards, their staff, their management, and of course, the shareholders like us. If all that's taken care of, we believe we get a terrific return. So what's an example of that? I've done one here for you today. City Chic Collective, which over the last couple of years has become a small cap darling in the Australian market. But it hasn't always been that way. It was spun out of a group called Specialty Fashion, which owned a whole bunch of retail brands, and we owned it as Specialty Fashion. So we stumbled across it, and the board did a fabulous job. They sold all the other brands and kept one brand, which was City Chic Collective. What do? They provide younger women larger size clothes, both here in Australia, New Zealand and the US, and probably in the not too distant future, Europe. We like that because it's got two terrific growth engines. One, larger size fashion is hard to get around the world, but we know that women and people come in all different shapes and sizes, and the big brands don't cater to those shapes and sizes. City Chic does, and that's common in all the countries that we mentioned. Great growth, but you've got to execute on that growth. City Chic have got another growth engine, which is they're mainly online. They started in Australia with stores, built an online business. When they've gone to the US, the really big market, it's gone the other way. It tried stores, it didn't work, it went online. So now they've got virtually an online business and they're the number one player in the biggest market in the world. They can grow for a long time. So two avenues of growth, a growth industry and a growth delivery to market. What about management? Well, we like management. They've built the business, they're direct, and they take into account all stakeholders, especially their customers. They listen to their customers and it's important to them. To us, we're going to win. If they get their supply side right, supply channels, which we think they can, they look after their customer, they move with the trends, they deliver what you want, you're going to get a terrific return. And so we see a great growth engine for us to invest in for a number of years. And that's exactly what we're looking for. Not easy to find, and we think the price, okay, it's at the top end, but we think over time the price will be more, the shares will be more than compensated by the growth they can achieve. So they're the kind of companies we like to be involved in. So what is investing in 30 or 40 of these companies and sometimes going to cash and having all this flexibility look like? As you can see on the slide there, our performance, our idea, as I said, we're not index aware. We start from scratch. So we're just trying to give you a return that is acceptable and on the risk that we take. We don't want to take too much risk. And if there is any one year where risk has been at the forefront, was the last 12 months. And the market, as we saw from February 20 to March 23, the small cap index, which we would concentrate on in that area of the world, was down 41% in less than 5 weeks, and then it rebounded like a moonball. Very volatile. If you left the market in late March, you're losing 40% of your money. We don't want to go through that. How did we go? We cashed up during late February, early March, and we started to invest again in early April. And at the end of the year, we produced a positive return. We beat the overall market by 13 or 14%. So I think the last year has stress tested what we think is acceptable with that flexibility. We raised our cash levels and we redeployed it in companies that we like at the right prices, which over the last 5 or 6 years has not been easy to do because prices have been very high with low interest rates. As you can see, over 1, 3 and 5 years, we've been able to beat the equities, and of course we've been able to easily outstrip cash, which has got to be your lowest benchmark. So we think that the model works, and we think that it will suit some people. Not everyone. Other people like more risk. We like to limit our risk but be exposed to a growth area of the market, and that's exactly why we've got our money in there. So performance has been solid. It's been true to label that we look to make sure we preserve your capital. That's the number one objective, and then get growth off the back of that by carefully selecting stocks. Where do we stand today? Well, believe it or not, we're pretty bullish. I know the market has bounced back a long way. I know the real world looks horrible, unemployment's high, but there's some things that we really like, and that overcomes those doubts. And the market, in particular, everyone I speak to, is still quite negative, uncertain, not sure where we're going. Well, the things that are positive are that we believe that interest rates are going to stay low for a long time. We don't think inflation will rear its head. If it does for some years, there's a lot of excess capacity, especially in the employment ranks. So we think that stays low for a long time. That's a good platform for equities. And over a 3-year period, don't try and get it in the next 2 months or the next reporting period or even the next year. Get it over 3 years where the economy and companies can recover, because that's what it's going to take. Maybe we get a vaccine that would fast track things in the next, say, 6 months. Maybe we don't, and so we have to learn to live with the virus. But we think economics will recover because it needs to be. We need to recover. People need jobs. We'll learn to live with the virus, I think, if the vaccine doesn't come. What we really like, though, from a company point of view, is when you go through recessions like we're in the middle of one now, is company cut costs. So when recoveries do happen and revenues do pick up, you normally get companies printing margins they never thought possible before because the cost line lags the revenue recuperation. And we really like that dynamic, and it's good for equities. So we remain bullish, especially with those interest rates so low. So how do we position our portfolio around the back of that? Well, at the moment, we're 90 to 95% long, which is above our normal trend. We've got 40 stocks. We've got a couple short related to the travel industry, which we think will take longer to get back on its feet, if at all, if it still looks the same. What are some of the stocks that we own? Unity Wireless, which is an internet provider for residential buildings. It sits beside the NBN and fills in where the NBN can't. Big demand for that. It's at scale. It's funding itself, going really well. We like that. Elders, which is riding the back of a rural recovery, not affected by COVID or not affected by as much. Atlas Arteria, which is owner of roads in Europe, and we believe traffic will be back up with public transport probably on its knees for a couple of years. and Credit Corp, which has been smashed, absolutely smashed by the coronavirus because it lends money to people and it buys debt ledgers. But we think you're getting it at a price really, really attractive because you've got the best management and or one of the best management teams out there in small cap land, and you have a balance sheet you can't jump over. So there's some of the things. Normally we would have 20% cash to take advantage of opportunities. At the moment, it's less than 5%. So we remain very bullish and will do so over the next couple of years. As I said, it's not a once in a generation opportunity the last couple of months, but it's definitely a rare opportunity with interest rates so low to generate a return. How's the fee structure work? Well, we're going to keep it small. We're not going to get big. We're not here to grow to $1 billion company or $1 billion fund and just keep the fees up. But we're going to keep it small. So we charge 1.25% to cover our overheads. And then our benchmark is more than a 5% return because, as I said, we're looking to protect your capital. If we can go above that, we charge a performance fee. But there's a high watermark as well. So we think that's the right package. Keep small, keep performing, and we, in the long run, we deliver you better returns, especially compared to cash, but you know, better than equities as well if you take it over that period. And we think that's a really good package, and it's where we've got our money. If you're interested in that alternative kind of product, you can see on the screen there's myself and Gary Joffe. You can contact us or our website. We think it's a nice alternative. It's one that people should consider to get a long-term return, and hopefully you'll think the same. Thank you very much.